We have Matt joining us from Lord Abbett today, and you actually were just in seeing our small cap team. So thank you for visiting us, and thanks for joining us on the podcast.
Thank you very much for having me.
Yeah, and you've also joined us on a very exciting day here in Seattle. So I moved here in 2008. I got to see the first time the Seahawks won the Super Bowl. I'm Australian, so they're officially my team. I moved, and then they won not long after. You're not a Seahawks fan, so but what do you think of the noise out there?
It sounds great. As a long-suffering Jets fan,
Okay,
the team I don't think has won a Super Bowl since, well, not in my lifetime. So you're very fortunate to have seen 2 Super Bowls
indeed.
just in since you've been here.
Yeah, yeah, absolutely. But at least you had at least one player you were rooting for on the
Yeah.
side, right? Yeah.
Yes. Yeah. We're all Sam Darnold fans, so
Oh, nice.
I was definitely rooting for him. Plus, the Patriots have won plenty, so
I
it's a
think
very
that's
easy team to root against too.
I agree with that. My wife is from Boston, so she doesn't.
Ah,
So we had a split household going
yeah,
on there.
yeah.
Thank you so much for joining us. There's a whole host of things we're going to talk about today, predominantly the biocap strategy that you've built sort of in concert with us here at Russell Investments. But if it's okay, I wanted to go back a little bit and maybe just share a little bit about your background. I think both of us have lived in the small cap space and also been at the same company most of our careers. So tell us a little bit about your background at Lord Abbett and before, and how you got to where you are today.
Yeah. I have been at Lord Abbett my entire career. That's 25 years, nearly all of it with the same growth team. I was lucky enough to cover a number of sectors before landing on healthcare. I covered consumer briefly. I covered financials briefly, thankfully before the financial
Okay.
crisis.
Yeah.
And then have spent most of my career as a healthcare analyst before becoming a portfolio manager. The great thing about covering a number of different sectors is I had good teachers to learn how to understand the fundamentals for each of those different sectors. But then I also had a very good mentor who taught me about the importance of paying attention to price trends. And I loved psychology and I love history. And paying attention to price trends, looking at long-term price trends of stocks is like the psychology and historians of the market. And I love growth investing and I love small cap stocks.
Yeah, and it's so funny. I'm right around 25 years at Russell Investments and joined as an intern here as well. So same firm. So that's actually kind of rare for our
Yeah.
generation. What was special about Lord Abbett that you think's made that possible?
Great people,
Yeah.
first and foremost. Great mentors, great people. It's a place where it's very collegial. You learn a lot from other people, but I think it's also a place where the culture is one of being very supportive. It also has a wonderful tradition. It's a firm believer in active management, a firm believer in fundamental research.
For our audience as well, the crowd is getting pretty loud back
It
here.
is.
So if you hear that on the podcast, it's pretty exciting. The Seahawks might be just about to pass us on Fourth Avenue.
Yeah.
Either that, or they really enjoy talking about
Yeah.
biotech stocks.
Yes.
So one or the other. So we don't just share that history of being at the same company for a long time, but until about 10 years ago, I ran our small cap funds
Yes.
as well. So as head of portfolio management, I'm not allowed to have favorites, but let's just say I'm excited to be talking about small cap investing with you. Is there anything else growing up in small cap land that helped you sort of think about growth, think about innovation, and how you pick stocks today?
Yeah. A few things. First off is that innovation and disruption is a key theme in our investment process. And so early on in my career, I was taught to focus on the truly disruptive companies, get as much weight in them as you can, and hold on to them as they're going through their dynamic growth phase. The second thing I'd say is when you go from working on small cap stocks to large cap stocks like I did. So, we've been managing micro caps since 2003, small caps since 2006, large caps since 2011. When you go from micro and small up to large, you have a different threshold for volatility,
Mm.
which I think is a good thing because I think, risk is correlated with return. And so I have a high comfort level for something that might have an intraday move that's 5 or 10%.
Right.
And I'm not easily shaken out by something that has more volatility if I believe in the long term. And so moving from small cap stocks to large cap stocks was very, I think, easier than somebody going the other way, moving from large cap stocks to small cap stocks where the volatility is much greater.
So if it's okay, let's go dive in a little bit to the biotech strategy that
Yep.
you run for our clients here as well. Um, I remember running the small cap funds, and this was a systematically underweighted area.
Yes.
Most active managers avoid
Yeah.
that segment of the market. They think it's binary. They think it's hard to analyze using traditional financial analysis. So a couple of questions. Why is that something that that you've been focused on? What kind of skill set do you think makes it possible to pick stocks in an area? And maybe if you want to throw some shade on your competitors,
Yeah.
what are they missing when there's what is a big chunk of the index that they're not investing in?
Sure. So there's a lot there. First off, I'd say is that investing in biotech is not different than investing in any other sector. You have to have a repeatable investment process, and you have to have specific things you're looking for. And then you have to make projections about what you think the revenue and earnings will be in the
Yep.
future. And I think to be successful, those revenue and earnings projections, you have to have conviction that they're above where consensus is so that you can take advantage of the power of compounding.
Yeah, yeah.
That if something's going to grow 30 or 40% over the next 3 to 5 years, and consensus thinks it's only going to grow 10 or 20%, at the end of those 5 years, you have a much higher revenue and earnings growth than where consensus is. The difference is oftentimes you're investing in these companies and projecting their revenue and earnings growth before they even have any revenues or earnings.
Right. Yeah,
You're
yeah.
analyzing clinical trials. But I just want to reiterate the foundation of what you're doing is the same. It's just that you don't have current revenue and earnings. And so the interesting thing is that there's a lot of data to analyze, and there's a number of ways that you can increase your odds of success. So let me try to give some specific examples. If you have a phase 2 trial where the clinical data is very clear, that increases your odds of success that the phase 3 is going to be successful. Oftentimes, a competitor, as you referenced, the
Mm,
competitor would say, "Well, that's binary."
yeah.
Well, it may not be binary. It might not be a coin flip. It might be that if you have a well-controlled clinical trial, the biology is very well understood, you have a well-designed drug, and something works in phase 2, it might be 75 or 80% or even 90% likely it's going to work in phase 3. And if the market is pricing it as binary
Mm.
or a coin flip, and you perceive the odds to be much higher than that, well, then there's some alpha that you can exploit from that. Why competitors don't do it is I think it's because it's complicated.
Yeah.
You need specialized expertise. You need to study it. I'm fortunate enough to have spent a lot of time studying the area, and I have a great team that is dedicated to this.
As you were talking there as well, you talked a little bit about the extra expertise required. And so, as well as being an investment thinker and have an investment background, I think you have an MS in biotechnology as well from John Hopkins. So, maybe you could talk about your own education and maybe the education of the team. What's different in how you've built the team out to be able to be successful investing in this space where it is different and complex?
Yes. First off, you are correct on my education, and I think that helps. But that started from me picking up the sector and going through the same process that I did when I covered consumer
Mm,
or when I did financials. I as a kid, I've always loved to read, and I think that is a advantage in this line of work.
yep.
And so when I started covering healthcare, and this is back in 2006 now, I started by reading everything I could about the sector. And I started with things that were not as technically challenging. So a great book I started with was this book about Vertex Pharmaceuticals that was from the 90s called A Billion Dollar Molecule. And I was fascinated by
Mm,
it because it married the business elements of starting a biotech company. Vertex is now a multi-billion-dollar company now, but also with the scientific and technical challenges of starting a biotechnology company. And then as the years went on, I was reading more and more technical work. And by 2013 or 2014, I was reading extremely technical journals or books about biotechnology, which ultimately led me to say, well, why don't I go to school for this?
Yeah, so this came in the middle of your career. You
Yes,
decided to dive deep
yes,
into the area. Okay,
yes.
so that's
That's
relatively rare. And if it's okay, let's talk about the building of the strategy now, if
yes.
that's okay. Again, having previously worked on these small cap funds, that gap in the biotech sector, we had tried to plug it in a number of different ways with quant strategies, asked, sort of partnered with you all. So I'd love to hear your side of that story. What was it like to partner with Russell to sort of build a dedicated biotech specific portfolio?
It's been great. Working with the team has been wonderful, and they've been very, supportive of our investment philosophy and investment process. We talked earlier about a repeatable investment process, and while this is true for all sectors, I think it's especially true in biotech. And we really marry both qualitative and quantitative elements to what we do. The qualitative elements are things like, okay, what is the business model like? If it's a new medicine, is it something that will be taken one time, or is it recurring? We also spend a lot of time with the management team. Have they done it before? Maybe we've invested with them before at a prior company. The management team's credibility is crucial because they're the ones who are going to be designing the clinical trials that need to be successful. They're going to be interacting with the agencies to get the drugs approved, and ultimately, they're going to be setting the strategic course to get the drug launched well. We have to look at what the sustainable competitive advantage is. In biotechnology, intellectual property is critical. How long does that go out? Competitive advantage can come in other forms too. Okay, they might have a drug that they've launched now, but is there an R&D pipeline so that there's other drugs behind that? So the R&D pipeline can serve as a form of competitive advantage. And then the last thing I'd say, and this is the last element of the qualitative, is what are the industry conditions? So there are parts of the FDA that are more accommodative than others, that are more likely to approve a drug on an earlier stage trial than other parts of the FDA. There are also therapeutic categories where you are more likely to have the reimbursement you're looking for than others, either because there's less competition or for other reasons. So all of this goes into, how big can this company and this drug be once it gets approved. Then, though, we want to see, okay, well, how well is the company executing? And so if you have a commercial stage company, then of course you're looking at revenues and earnings just like you would for any other company in any other sector. When you're looking at a pre-commercial company, you're then evaluating the clinical trials. How are the clinical trial results doing compared to consensus expectations? How are they doing compared to the competitors that might be out there, both on the market or in development? So this is all very quantitative. If you're looking at a cancer drug, you're focused on the response rate, which is very quantifiable, or the survival rate, which is very quantifiable. So all of these things are things that you can measure, and that's why I say they're quantifiable. And then last but not least is, I referenced before, paying attention to price trends. We look for price trends to see if there's signals that perhaps tell us if we're too early on a stock, or if something is changing negatively. So if you have the potential that I described, these qualitative elements that we're looking for, and then it is being confirmed by good clinical trial results or good launch metrics and revenue and earnings, and then you're seeing the market recognize that with good absolute price trends or relative price trends, those are the types of stocks that we want to own. And the portfolio we manage with Russell is around 50 stocks today.
Yep.
And it's a small cap universe. So, most of the companies are, under 10 billion in market cap.
Great. No, we really enjoy that we're able to bring this specialized sector to our clients. So I wanted to talk a little bit about the opportunity set within the biotech segment right now. So what are some of the themes, the sectors? You see advances in oncology that are
Yeah.
very exciting. Advances from the use of GLP-1s is very topical.
Maybe I'll hit GLP-1s first. We think Lilly and Novo have an incredible advantage there. That said, there are some small companies that might have a dosing advantage, or might be going after a slightly different mechanism of action for weight loss that we think are worth investigating. However, even if those are successful through clinical trials, the challenge will be the significant scale up in manufacturing. And so weight loss and obesity is an area that is very attractive. But for a small and medium-sized company, might be a little bit harder because of the established competition. I would contrast that with something like oncology or rare diseases, where you don't need a very large sales force. Often, there isn't a huge manufacturing scale up. These tend to be more niche indications. The likelihood that you can have a high probability of success if you find a good medicine that it can be launched by the company
Right.
is higher. Those are two areas where we do spend a lot of our time, oncology and rare diseases, that is. There's been a lot of breakthroughs in oncology over the last, 25 years. There's areas like, though, like pancreatic cancer where 5-year survival rates are still very low, but we're finding companies that are working and have shown some promising clinical results in pancreatic cancer. There's other areas like, liquid tumors like myeloma, where there has been a lot of progress over the last 20 years, where the 5-year survival rates have improved meaningfully. But there's but even in situations like that, where you've had an improvement over the last 20 plus years, there's still an opportunity for a differentiated company to come in with something new, and a new mechanism of action, which can be additive to the progress that's been made over the last 20 years. I would say in rare diseases, I think the example that a lot of people talk to about a meaningful impact is Vertex, the company we were talking
Oh,
about
yeah.
before.
Yeah, yeah.
Of course, I read the book about Vertex when they were, still just a tiny little company. Now Vertex is has you know transformed the field of cystic fibrosis, in which kids who were born with cystic fibrosis 25 years ago had a lifespan of 30 years, and that's now well over 60 years.
Yeah, yeah.
So dramatic improvement. And there's other rare diseases where, that level of progress is has not been seen. But in things like spinal muscular atrophy, SMA, in other areas like, Duchenne muscular dystrophy. There's other rare diseases that, um, uh, where a lot of progress is being made. I think the appeal of both oncology and rare diseases, they often have very clear genetic drivers. So the biology is well understood, and so the design of a medicine that works in those areas, you can trace very clearly from early clinical trials to late clinical trials.
It's a really exciting, sort of innovative time to be investing in this space. Can you talk about a couple of the key catalysts? Biotech started to outperform a little bit last year. What might be the catalyst for that to continue?
Great question. And I get asked this a lot, and sometimes I get asked it a little bit of a different way, which is biotech's outperformed
Yeah,
over the last 4 or 5 months. Is that it?
yeah, yeah.
And I think that this is the beginning of a new bull market in biotech. Or said another way, I think we're emerging from a 4.5-year long bear
Mm.
market. I'd like to remind people that during the tens, uh, biotech dramatically outperformed the S&P.
Yes.
The XBI was up sixfold through the end of 2020, and the S&P was up threefold. And 8 out of those 10 years, biotech, the XBI is the index for biotech I'm using roughly, uh, outperformed the S&P 500. One of the drivers behind that was innovation.
Yeah.
And I don't think that has changed. I think the innovation story has continued. However, in the last 4 years, you had a few different things going on. First off, you probably had bubble-like conditions after COVID, that the market had to work off. So you had a blow off top in the bull
Right.
market in late 2020 that the biotech market had to work off. What happens, late stage in a bull market, a lot of IPOs come to market, things get overvalued, and so you have conditions that lead to a bear market beginning. You also had rates go from a low level to a high level. Rates, have been stable now around 4.25% for 3 years. I think stable rates, are a good backdrop for biotech. The last thing is the administration, when it first came in, I think there was some, concern, uncertainty around, regulatory.
Yes.
That could be related to price, but it also could be related to the FDA. And I think what the market has seen, over the last 6 to 12 months is that the FDA is operating, for the most part, consistently and as expected. Dr. Makari leading the FDA, seems very committed to getting new medicines approved quickly, much like
Quickly.
his
Yeah.
predecessor was. And so that has been fine. And then some of the pricing concerns that were raised early in the administration um, have turned out to be not nearly as draconian as feared. And that really resolved in the summer timeframe, summer fall timeframe, which is when you saw biotech begin to outperform. That certainty on the regulatory front, I think, as well as rates being stable, also allowed these large biotech and pharmaceutical companies, which have large patent cliffs, to then begin to re-engage in M&A.
Yeah.
And so Q4, another driver of the performance in the second half of last year, is you did see an uptick in M&A, which I think paused for a while as some of that uncertainty was clouding this sector.
As you were talking a little bit about the timeline of sort of a drug going through the FDA pipeline, how real is the impact of artificial intelligence and the way that that can impact the timeline and the efficacy of a drug coming through the pipeline? How much does that change things?
I would start this with, we have to appreciate that biotech and new medicine discovery operates on a different timescale than technology.
Mm.
Somebody creates an app with AI, as we're learning
Yeah.
in the market, it could be available in days.
Yeah.
That doesn't exist, of course, in biotechnology. You still have to go through clinical trials. You have to go through the FDA. However, I'm extremely excited about artificial intelligence in the same way I was extremely excited about genomics in the early 2000s and the breakthroughs from genomics by companies like Illumina that really unlocked greater understanding of biology combined with, better clinical trials, improved uh, uh, design of medicines. And so I think what you'll see is that um, those dramatic improvements we were talking about before, whether it be in oncology or in cystic fibrosis, those played out over 20, 25 years. And I think what we'll see over the next 20, 25 years is you'll see more breakthroughs like that, uh, enabled by better, faster, uh, new medicine uh, development and approval enabled by artificial intelligence. The other exciting thing is these benefits will not accrue equally across the sector in the same way that the benefits from genomics did not accrue equally across the sector. There are companies that use these new tools, exploit these new tools, and have a better return on R&D than others. And the same will happen with generative AI.
And you talked about having about 50 or so stocks in the portfolio. Do you feel like that level of diversification is important? Because even with an information edge, there's still sort of an asymmetry of payoffs.
Yes.
Is it fair to say the winners can be big winners, but you can't get them all right?
Yeah. We operate in stocks that can go up, several fold
Yep.
in a year, and stocks that can go down 60 or 80%. So you have to manage your position sizes for that. That's true across every sector, but to a different degree. In
In biotech.
exactly in technology, a good year maybe stock goes up 100 or 125%, and a bad year it goes down 50. The range of outcomes in biotech are higher. Which what did we talk about at the beginning? Like,
Yeah.
my level of comfort with that risk,
Yeah.
has always been high. Um, so when I hear that, I don't think risk, I think that's alpha opportunity.
Yes.
If you have huge
Dispersion.
exactly. If you have huge dispersion of returns, that creates opportunity.
You talked a little about the broader small cap sector as well. So we've talked mostly about the biotech portfolio, which, as you can tell, I'm really excited about.
Yes.
It plays a wonderful role in our small cap funds. But at the same time, you do manage broader small cap growth portfolios as well. So I was hoping you could share a little bit of your thoughts, your outlook on both the alpha and the beta profile for small cap going forward. It's been a couple of years, many years of small cap lagging large.
Yeah,
The active management environment's been a little bit challenging. So how do you think about the small cap opportunity set more broadly?
sure. I do think that a number of people have been, um, predicting that small cap or mid cap would start to outperform based upon a relative valuation disparity versus large cap. That's been true for the last 4 years. That is still true today, and so you have a very good starting off point for small cap stocks or mid cap stocks. What's different now, though, and the catalyst now, though, that I think is positive, is that the earnings growth of small cap is finally no longer at a huge disadvantage to
Right.
the Magnificent Seven. So in 2024, Magnificent Seven earnings were 38%. Russell 2000 earnings were negative, and somewhere in between were mid cap and other large cap stocks. You look out to 2026, I think the earnings growth for small cap stocks is going to be 15 or 20%. I think that the Mag 7 is still going to be very healthy, but it's coming down from that 38% level. Maybe it's 25 or 26%. So that's maybe the beta.
Yes. Yeah.
The alpha is, and I don't know if I wouldn't differentiate this from the large cap strategies I manage either. I think there's a lot of alpha opportunities because of the disruption that's happening from, we could start with generative AI, but it can be from a whole host of things. And that is to say, companies that are deploying these tools are going to see benefits, and companies that don't successfully deploy these tools are going to underperform. So I think that we are in a period where the dispersion in the market, the alpha opportunities in the market, not just by sector, but within sector, within an industry, it could be in the trucking industry where you have companies that are outperforming and companies that are underperforming. In the banking industry, outperforming and underperforming. So I think it's going to be a period where, as an active manager, there are going to be a lot of opportunities because of that.
And we wanted to finish off today with a series of questions I just want to ask you. There's a sort of a one-line answer. Just tell me whether you're risk on or risk off the following categories.
Okay.
So the first one is, has it been 10 years or so? Will the Russell 2000 finally outperform the large cap index next year?
Risk on.
Risk on. All right. Biotech outperforming the Russell 2000 this year?
Risk on.
Risk on as well. Okay. How about betting on a new stock idea before it's been widely accepted by the market?
That's a good one. I'll say risk off.
Risk off. Okay. Is that back to your price trend? I want to see some price action first.
Yes.
Yeah.
Although by answering that question as risk off, I feel like that's actually a risk on answer because it is different than what others would say, but I'll still say risk off. But you're right. I think that I believe in the wisdom of crowds.
Yeah.
And so I would prefer to miss the first 20% move, get some more conviction so that I could be there for the next 50 to 80% move.
Yeah. Oddly, I think by thinking about momentum, that makes you a contrarian. And
Exactly.
So,
Yes. That's
totally agree.
yeah.
And then finally, this is a personal one because I did it the other day. I have a broken foot.
Yes.
Using ChatGPT as for personal medical advice.
Risk on
Risk on.
with caveats.
Okay.
Talk to a doctor too.
Okay. Thank you.
Yeah.
Well, hey, thank you so much, Matt, for joining us. Like I said, you're playing a really valuable role in the Russell portfolios and in a really exciting and innovative sector. So thanks for joining us and good luck getting through the traffic out there.
Thanks so much for having me.
Thank you.
Lord Abbett provides sub-advisory services to Russell Investments funds and clients and receives fees for those services. Lord Abbett was not paid to participate in this podcast. Because it has an ongoing business relationship with Russell Investments and receives compensation, it is financial interest in that relationship, which creates an incentive to make favorable statements about Russell Investments. This podcast is intended for informational purposes only. The content provided within the podcast should not be construed as investment advice, research, or a recommendation, solicitation, or offer for any specific Russell investment or other product, strategy, security, or service. The information does not take into account the investment objectives or circumstances of any particular investor and may not be appropriate for all investors. All investments carry a level of risk and do not typically grow at an even rate of return and could experience negative growth. Any past performance results should not be seen as a guide to future returns. All opinions presented are as of the date of the recording and subject to change without notice. Information contained within the podcast is obtained from sources believed to be reliable but not guaranteed. Reliance upon the information provided in the podcast is at the sole discretion of the listener. The general information contained in this publication should not be acted upon without obtaining investment advice from a licensed professional. This podcast may involve discussions with non-Russell Investments personnel. The views and opinions expressed by non-affiliated personnel in this podcast are those of the speakers and do not reflect the policy or position of Russell Investments or or its affiliates. This content should not be construed as a recommendation or endorsements of any third-party manager featured on the podcast. Some of the portfolio managers or firms featured in this podcast may manage funds or accounts that are offered by Russell Investments, and they may have business relationships with Russell Investments or its affiliates. Neither Russell Investments nor any of its staff accepts any responsibility for or liability with respect to the information or opinions contained in this publication. In EMEA, this content is suitable for professional clients only. Capital at risk. Copyright 1995 to 2025 Russell Investments Group LLC, all rights reserved.